right? So what we're going to do is something very simple. We're going to select 3 stocks, and we're going to try to find the combination of the 3 stocks that give us the highest return in a certain period of time. We have to think about how to do that, as well as what criterion we use to say that it's the best combination. So let's first find some data. The easiest source you can get would be Yahoo Finance, as I've mentioned, because it's online and free. So let's just go to Yahoo Finance, and we're gonna pick 3 stocks. It's always good practice to have a diversified portfolio, so we're gonna pick one stock from financial sector. Let's say Goldman Sachs. Right, Goldman Sachs is GS, so you search for Goldman Sachs, and in Yahoo Finance you can download data from the historical data tab at the right hand side, right, slightly to the right. So go to Goldman Sachs and historical data. So you have so it allows you to choose time period. It allows you to choose time periods and frequency. So let's just use 10 years of data, right? So 10 years of data, so that would be somewhere around 2008 to 2018, right? So that's 10 years data. In most finance research, you look at monthly return, so we will also use that. We're going to frequency switch to monthly, right? So as you see, we have made 2 changes from the default option. One is we have switched, we want 10 years of data, and second, we want monthly data. Once you select these, you have to click apply. It's not automatic. So you have to click apply. Once you click apply, then you see that the data is switched to a annual frequency. Oh no, sorry, monthly frequency. Right? It has switched to a monthly frequency. Switch to monthly frequency, and then there's a button. There's a link on the right below the apply button, which allows you to download data in the form of a CSV file. So that's what we're going to do. Click download and save it somewhere, right? So, okay, so just save, right? Once you save, let's open it. When you open the file, it should show up as a table with 8 columns. So the 8 columns are the date, which, as you see, is the first day of the month, which just represents that month. The opening price of the month, the highest price of the month, lowest price of the month, closing price of the month. Adjusted closing price. You can see that there's actually a difference between the adjusted closing price and the closing price. Right, it's actually quite a substantial difference. So why is there such a difference? The adjusted closing price includes dividend and splits, right? So the closing price is just the price you see on the on the quote, right? So this price might mean different things in different time if the stock has undergone a split or reverse split. Adjust closing deals with that for you, so you don't need to think about you don't need to check whether there's split or reverse split. So we're going to use the adjust closing because that makes it easier for us. Otherwise, you would have to manually, if you want to use closing, then you have to manually incorporate the effect of having dividends and splits. So we just use the adjust closing. And finally, you have volume. Volume is just the shares transacted in a particular day. It's usually very large number, so you can. That's why it's in scientific notation. If you expand the column, then you'll see all the numbers. We're not going to use that. We're just going to use the adjusted closing. So what we're going to do is we're going to copy the data, right? Just click column 1, copy, right? And then we're going to paste to our Excel spreadsheet. Paste, right? So that's the date which we're going to use. And then we copy the adjust closing. Copy. And paste. Oops, wait. I must have clicked the wrong button. Ooh, I must have clicked paste. Okay. Copy. And then go back. Paste. All right. So that's our first time series of data. So that's Goldman Sachs, right? I'm just going to change the name to Goldman Sachs, since that makes it so. Since we're going to have more than one stocks, and we don't want to call all of them adjusted closing, right? So I'm going to rename it as Goldman Sachs. And we're going to repeat that for 2 more stocks just to demonstrate this exercise. So we're going to pick one from, let's say, the technology sector, right? We're going to pick one from a technology sector, like IBM. So IBM's ticker is just IBM, right? So we're going to go for IBM. And once again, you go, here we are already. Oops. You don't actually need to do anything, right? So now, I should. So you see that you only need to select the frequency and the duration once. Yahoo Finance in the current version would keep the same setting as long as you don't as long as you don't reload, right? You can keep searching and it would keep the same frequency. So we don't need to select the game. Instead, we just download the game. Right, so this is IBM. Right, wait, this is Goldman Sachs still? Is it still Goldman Sachs? Let's see. It is. All right, let's try again. IBM. Here you go. Right, this time it should be correct. It's IBM. And then download data. And do you want to save IBM.csv? Yes, save. And then we're going to open it again. We're going to copy. Oh, all right. Ooh, it's just 1 month, huh? So I must have missed the duration. Huh. But it does say it's 2008 here. Right? It does say that. Okay, so I guess you have to click apply. It's not that smart after all. You have to click apply. Right? Even though it keeps the setting, you still have to click apply. All right, let's make sure that it actually works. It does. Okay, now it looks like it's working. So right. So now you can download the game. Save. All right, and open. Hopefully this works. Yes, it does work. So, okay. Yahoo Finance is kind of strange in that it keeps the setting, but you need to manually click apply. So once again, we're gonna copy the column F with adjusted closing. Copy, and then you go to your own spreadsheet, paste, right? And then this is IBM. Let's pick one more, right? Let's pick one more. Let's say we pick one from the like a sector that is not very correlated. Say 3M, right? MMM. So 3M produce like things like tapes, right? So it doesn't actually have. It's very far from these other 2 industries. So that seems like a good way of diversifying. So let's once again do that. Remember, you have to click apply. And once you click apply, you can download data again. So 3M. So type MMM. So that gives you 3M company. Click apply to select the range of data you want, and then download the data. Save. So open. So this is the last one we're going to use, since it's just for demonstration purpose. Once again, copy column F to the book 1 we have, and this is called MMM. Alright, so that's the 3 we have. And once you've done that, we can close the other spreadsheets that we don't need. Don't save. Don't save. Don't save. All right, here we go. So now we are left with 3 stocks. Obviously, you don't need to use Yahoo Finance for this. If you don't want to use Yahoo, you can totally use DataStream and Bloomberg to get the same data. Yeah. So, but for us, just to make it easier to do it at home, we will use Yahoo Finance. And now what we're going to do is we want their returns, right? After all, the stock price itself is not very informative. What we want is return. So we're going to have Goldman Sachs return, IBM return, and then MMM return, right? Okay. So we're gonna look for the 1 month return. So it would just be the price today minus the price last month divided by the price last month. It's quite clear that the first month would not work, right? Because there's no data, right? So, but that's okay. The next month would work, right? So, so that means that we would need to skip the first 2 months in this case, because the first month actually contains no data, right? So in this data, the first month that you can actually calculate a return would be April 2008, because you need the data from March 2008 in order to calculate a 1 month return. To make it easier to see, we're going to switch to a percentage notation, right? Let's say with 1 decimal place, right? So Goldman Sachs actually did pretty well in April 2008, 15% return in 1 month, but look at the next month, it's going to go down 7% again, right? And now you can already see the benefit of diversification, because IBM is way more stable than Goldman Sachs in these 2 months, right? So that's why you want multiple stocks instead of single one, right? And what we're gonna do is just drag these formulas all the way down to the bottom, and there you go, the return of all months in our data. Let's calculate the average return just to get an idea of how these stocks are performing, right? So let's just get an idea of that. So we have Goldman Sachs, IBM, and MMM, and let's say we have the average return, right? And and the standard deviation of return, right? So that's just a simple average of the whole return series, right? So you just type average and then click the whole column. Excel is smart enough to ignore any text you see, right? So you don't need to deal with that. Average MMM. All right, once again, let's switch that to percentage notation to make it get a better idea. All right. Okay, so the average return, well, perhaps surprisingly, depending on how closely you follow financial news, 3M actually gives you the highest monthly return in this period in the past 10 years. One of the reasons is that if you follow financial news, is that you would have thought that financial sector is quite profitable, but it was not in the past 10 years. Since the financial crisis,
financial regulations has made it a lot harder to make money in the financial sector, right? So it turns out it's not that profitable. Okay, standard deviation, similarly, STD, DEV, it doesn't really matter which one you use. We're going to just use the population one, the first one. STD, DEV.P, for our purpose, is not really important which one we pick. They are pretty similar when the sample size is large. So STDEV.P, right? STDEV.P. Let me just even, and then click on the second column. Let me just zoom in even more, right? Zoom in more. That makes it. All right. Okay. Finally, the last one, STDEV.P, MMM. All right. So yep. Yeah. Okay. So I'm not. That's why I don't use Mac. But in any case, what you can do is there's a text to column, whatever language this is. Okay. So what you want to do is to say it's one of them should be delimited. Which one? Semicolon. Semicolon, right? Comma. No, that's not semicolon. That's done. Not the first column. So what you need to do is you actually need to select the whole page. Do what I did just. Select the whole first column. Text to column. Next. Comma. Done. Huh. That's interesting. Because of these. Anyone have issue? No Monday issue. Done? Yeah, good. Right. So, well, it's okay if you don't have a laptop. I will upload this example online, and we have the video here. Hopefully, it would work. Right. So, in any case, once again, these are the figures we have. Oops. All right. So another thing you would notice is that the volatility is really high compared to the average return you can get. That's why stock, as we have mentioned, stock market does appear really risky if you're looking at short durations, right? You're getting something like 1% return for 8% standard deviation, right? So that sounds really risky. Okay, right. So now what we need to do is that we need to construct a portfolio where we invest in these three stocks and then get an idea and try to find a combination that gives us the highest return possible, right? So we need a basic portfolio. So we have a portfolio. We're gonna have a portfolio, right? Now, in order to construct a portfolio, we need to say how much money we put in each stock, right? So we're gonna have a weight for each of these stocks. This weight should add up to 1, right? Okay. So just to start, we're gonna assume that we're gonna start with 0.3, 0.3, and then 0.4, right? And then the last in the row beneath the weight that I just manually type in, we're going to type sum of these weights. It's important that this is a formula because that's what the Excel solver is going to look at when we try to find the optimal weight automatically. So the last row, right, beneath has to be the sum of the previous 3, and it should add up to 1, right? Okay. So we're gonna assume that we have an equal weight we're going to have the same weight throughout the period. Right? You could have something much more complicated if you want. You can still do it in Excel, but for our purpose, for demonstration, we're going to just use the same weight throughout the period. Okay. So now to make it easier to make it easier to calculate, we're going to insert another column here. This is the portfolio return. I just port return, right? Just for simplicity, right? So the portfolio return is just going to be the average of the individual returns, right? A weighted average of the individual returns, right? Okay, so we're going to select the weights. So the first weight is M2, and then we're going to multiply that with Goldman Sachs return plus the weight of IBM, which is M3, multiplied by IBM's return plus M5, which is the weight, M4, which is the weight. Oops. Yep. Okay. So the average return is 5% in this month. Now, if you try to drag this formula, you realize that it's not going to be correct. Because notice that the formula goes from M2 times blah plus M3 plus times blah plus M4 times blah into M3, M4, and M5, right? So because Excel try to second guess what you're doing, it would automatically shift the rows for you. So that's not what we want. So that's not correct. Instead, you have to lock these cells. How do you do that? You can manually type in $signs, or you can press F4. If you press F4, then it would add $signs for you. If you keep pressing F4, it would shuffle through different combinations. So if you have a $sign in front of the alphabet, that means you want to lock the column but not the row. If you have the $sign in front of the number, that means you want to lock the row but not the column. And if you have $signs in front of both, that means you want to lock both of them, right? For our purpose, we can just lock both of them. Doesn't matter, right? So now, if you drag it, you would see that this is correct because these weights have been locked to a particular position. Okay. Once again, what we need to do now is to drag all the way down. And that's our portfolio monthly return. That's what you can get every month. If you buy at the beginning of the month, sell at the end of the month, that's what you get, right? Holding stocks for exactly 1 month. So now we are interested in knowing the average of what we get in that case. Well, the average turns out to be somewhere around 1% at this moment. And then similarly, STD EV.P, the standard deviation is about 5%. Now, this is clearly not a very good combination right now because it's quite clear that just buying 3M would be a better choice. It's possible. It's possible that in these 10 years, there's one single stock that performs so well that you just want to buy that one, right? So we'll see whether that's the case. All right, so that's the portfolio average return and the standard deviation, right? That's the portfolio return and the standard deviation. What we need to do now is we need a criteria to balance the return and standard deviation. If you just maximize average return, you would find yourself in a highly leveraged combination where you just basically go all in for the stocks that have the highest return, right? And the risk would blow up in front of you because all you want your program to do all you want your portfolio to do is to give you the highest average return, which usually comes with a lot of risk. So we need a way to balance risk and risk and return. So one of the ways to do that is to use what we call the Sharpe ratio, which is defined as the excess return Sharpe ratio is defined as the excess return, well, defined by the standard deviation of your portfolio return. Right, so that's what we're going to use. And to do that, we need to calculate excess return. So how do you calculate excess return? Excess return is the return of your portfolio, which we have now, 0.9% a month, minus the risk-free rate, And so we need the risk-free rate. Okay, so where do you get the risk-free rate? Typically in finance, you would be using US Treasury bills or bonds, right? We are using US data, so you use US interest rate. So you go online, go to just search for US Treasury yield, right? So Google US Treasury yield, you will find the daily Treasury yield curve from the Treasury Department of the United States. You can select it. So here you see the list of yield. Now these are annualized. These are annualized returns, right? So what this says is that for 1 month US government T-bills, the return is 1.41% annually. Whereas if you buy 10-year T-bonds, it's 2.78% annually. So that's why there's a yield curve, because the annual yield of risk-free asset is not the same since liquidity has value, right? When you borrow money to someone for a long time, even if there's no risk, you still want higher return, right? So that's why you can see there's quite a bit of difference. It's not always true that short-term interest rate is lower than long-term interest rate. There has been time when short-term interest rate is higher than long-term interest rate. This usually happens in time of confidence crisis, when people think that the government might default in the short run, but is probably recover in the long run, right? So, but normally that's what you should see. That short run interest rate is lower. Which one should you use? That depends on your investment duration. For our purpose, we're doing a really short investment duration. We're just using like a 1 month, right? 1 month investment duration. We are saying that we're clearing a portfolio every single month. So you can use the 1 month T-bill. You can use the 1 month T-bill, and remember that's annual return, annual interest rate. So you have to divide that. With into 12 by 12, right? So that's what we're gonna use. Technically, it would be better if you download the time series, right? Technically, you should download the time series. I'd say interest rate doesn't change that much compared to stock return. So we're just gonna be lazy. We're just gonna say it's around somewhere like 1.3, I think, throughout time. You can actually access the interest rate throughout different months. But for our demonstration, it's slightly higher than 1. So let's see. Oops. What? Is there a way that I can easily see what it's about? See a chart. It doesn't have a chart. Well, what is it? So let's pick somewhere in the middle. Okay, let's pick somewhere in the middle. Now you see that there are times when it's quite low, right? So you should download time series if you're doing this seriously. But let's just pretend that we're going to use the 2008 one. Let's just use the latest one, right? So let's use something like 1.3. Okay, just about 1.3. We're just going to use 1.3. So just to be simple, we're going to use 1.3. So that's 1.3%. So 1.3% divided by 12.
So if you want to do it seriously,
you would have to add another column.
Oh, so
you want to add here the risk. You want to add the risk-free rate, right? You want to add the risk-free rate, and then you would have to download time series from Treasury's website, and then remember divide by 12, since it's always in annual term. It's always in annual terms. But for here, we're just going to be lazy. We're just going to treat it as 1.3, like 1.3% divided by 12, right? So it's about 0.1% a month, right? Okay. So in some sense, the risk-free asset, the risk-free asset doesn't give you like complete. It doesn't mean it has no volatility. The government doesn't default, but there is still volatility in the return, right? All right. So excess return. Excess return is simply the portfolio return minus the risk-free rate, right? So that's the average per month excess return. That's 0.8. And finally, the Sharpe ratio. Sharpe ratio is the excess return divided by the portfolio risk in standard deviation. So that's excess return divided by the risk of the portfolio. There's some theoretical justification of why you want to use this. For example, why don't we use variance instead of standard deviation? Why do we use standard deviation? There is some justification for that. This is Sharpe ratio is published by someone named Sharpe, right? Last name Sharpe. So it's actually he actually has a paper that explains why this is a good measure. But for our purpose, it's somewhat like beta. It's just have entered common usage, right? Have used common usage that even if you don't know the underlying theoretical foundation, it's still very commonly used. So that's what we're gonna use. Right, Sharpe ratio. Once again, we probably want to, we don't need that many digits, so let's just shorten it to 1 decimal place. Okay. All right, here we go. So now we have everything we need. Right now, our Sharpe ratio is 16.2, but it shouldn't be a percent, I think. It should just be something like 0.16. But it doesn't matter. It doesn't matter. As long as we understand that this number is the ratio between your risk, your excess return, and standard deviation. You can keep it any way you want. Okay. All right. So now what we need to do is to try to maximize the Sharpe ratio. That gives us the highest return per unit of risk we take on. So what we need to do is we need to adjust these weights such that the Sharpe ratio is the highest. We can do that manually, but that would be not very efficient. You can, especially because what we're having is already a very simple model. That's the simplest I can think of. In practice, you would have much more complicated model. There are more factors you want to consider. There's no way you can do it by hand. So you need Excel to help you out, and what you need to do is to use the Excel solver, right? So the Excel solver is not installed by default. If you want to use it, you have to install it. So you go to options, and then go to add in. This is for Windows only, right? For Mac, I think you don't depending on the version, you simply do not have a solver coming along with it. And then, so option, add in, go to the bottom, go, right? Just go. And then it will open a window and one of the option, the very last one here, is solver add in. Don't ask me why it is so hidden so well, right? I don't understand. In any case, click solver add in, click OK, and then wait for a few seconds. It would have, and it looks like nothing has changed. But if you now go to the data tab, it would in the right at the very right end, you would see solver here. For Mac, as I said, depending on version, some of the versions simply doesn't come with a solver. You have to actually download something else. Right, so now what we're going to do is we're going to open solver. So click on. Okay, that doesn't sound very good. All right, here you go. All right. Once you click on open solver, it opens an interface, and it opens the interface. There's a lot of things you have to enter. So let me explain what it does. Solver is a numeric optimizer. That is, it tries to do change numbers in a way that reaches a goal you specify. So typically that means you probably want to maximize or minimize something, but you can also say I want this number always to stay at a particular value. That's okay. So the solver helps you to reach a certain objective, and for our purpose we want to maximize. So that's the default option, maximize. The value we want to maximize is not, in this case, not M3. By default, it just shows whatever cell you happen to click on. For our purpose, we actually want to maximize the Sharpe ratio, so we should click on the K10. In my case, right? So K10. So you click on the Sharpe ratio. You want to go and click on the Sharpe ratio, and then just go back out. So the objective is the Sharpe ratio. We want to maximize it, and then the next option is that you need to tell solver what cells you can change. Set by changing variable cells. So once again, you click on what you need, and in our case, we can highlight the weights because we are changing the weights in order to maximize the Sharpe ratio. So are we done? No. Since right now we haven't specified any limitation on what the weights can be. So what's the best way to increase the Sharpe ratio? Well, the weights could go really weird, right? It could go very large numbers because you haven't said anything about what the weights can be, right? So we're going to add a constraint. Oops. Oh, sorry, that's K10 for some reason. All right, you have to add a constraint. So constraint, it's just formulas that you can add it to specify what the value of a particular cell can be. In our case, what we need is that the sum of the weights, M5, has to be exactly equal 1, right? Because the weights you always have to use the same amount of money, right? So they should sum up to 1. Right? So the first set objective is the Sharpe ratio. Second, maximize the objective. Third, select the weights to be the cells you want to change. And finally, add a constraint. Add a constraint that says that the weights have to add up to 1. Right? You can't so you have that much money. That's your limit. Right now you can solve. The solver has different algorithms that helps you to maximize. There's a short explanation beneath. Generally, you don't need to change that. Just leave it as it is, and you click solve. Okay, solver found a solution. All constraints and optimality conditions are satisfied. So let's put this aside for a moment, and let's see what happens. So, solver, through numerical optimization, basically guessing different values in a smart way, right? That's numerical optimization, guessing different values in a smart way. After some rounds of guessing, it found that this value, this combination of weights, gives you the highest return, a highest Sharpe ratio, by about 6% of IBM and almost 94% of 3M. That's not really surprising, since 3M has the highest return in this period of time. But even then, there's actually some benefit in buying IBM. Even though IBM is not that. Now, if on paper, if you just look at averages, right, IBM has a lot lower return, but not a lot lower risk, right? It would seem that that's not a very good investment. But it turns out that it's a good idea to buy some of it because it does help you diversify. And this is reflected in a much higher Sharpe ratio than before. Previously, we have 0.16. Now we have 0.2. So it's quite a bit of improvement, right? Right. So it's quite a bit of improvement. So right. So the standard deviation is actually lower than the individual standard deviations because of diversification. Some of the risk cancel out, right? Because in some months IBM will be doing better than 3M, and in some other months 3M will be doing better than IBM, as we have seen last week. By buying multiple stocks, you can diversify the risk and achieve a lower risk than any individual stocks can give you, right? So that's a very simple demonstration of that. Okay, so if you are satisfied with this, solution, you can keep the solution. You just click OK in this case. But in some other cases, maybe the solution is not what you want, and you might want to restore to the original value. Then you would select the second one, restore original values, and click OK. Now, in this particular case, I'm going to select restore original values because from a realistic perspective, if you're actually managing investment for other people, it's very unlikely you would be willing or be allowed to put over 90% of your portfolio in a single stock. So let's restore. Think about Hang Seng Index. No matter how high a stock can go, like Tencent, no matter how high Tencent can go, it can't account for more than like 10% of Hang Seng Index, right? So that's just because you don't want a single stock to dominate your index. So similarly, in many portfolio, when you are a portfolio manager, very often your fund would have rules limiting how much money you can put on a single stock. So perhaps it could be 30%, or it could be something like 50%, but certainly not 90%. So we're going to add in additional constraint to make this more realistic. So we're going to add another constraint. This time around, we would be requiring each cell to be smaller than, let's say, 50%. Actually, this is not a very good idea because we only have 3 stocks. So perhaps that's not very realistic, right? Because if you only have 3 stocks and you need to be 50%, in our case, we actually only want to invest in 2. So then, yeah, it's going to be perhaps problematic. So let's just so we can select the weights, right? I'm going to select the weights, as you can see. Select the weights. And it has to be smaller or equal to, let's use something like that would work better in our case. Let's say 70%, right? 70%. Just to demonstrate. You would see that in this case, you would always be reaching this constraint because we already know the best trade-off is going to be 93% in 3M. So if you limit it to 70%, then the solver would end up putting 70% in 3M. But let's see if it actually works out that way. So I've added a constraint that says these three cells each have to be below 0.7. Right, it's a bit small, but that's what I'm doing. These three cells each have to be smaller than 0.7. Okay. Now you see that we have now two constraints. We now have two constraints. We have two constraints. All right. So now once again we click solve. And as I've indicated, solver put 70%, the maximum allowed amount in 3M, because that's as far as it can go. It's interestingly, it decides to put actually some weight into Goldman Sachs, right? It decides to put some weight into Goldman Sachs. Let's just keep this for now. One thing you notice is that first, the Sharpe ratio is actually not very lower. Now, I didn't have more digits to check. But one thing to note is that numerical optimization is numerical optimization. So it's not guaranteed to be global maximum. It only gives you global local maximum. Sometimes it's possible that you reach an even better value after some trial and error. Generally, what that means now. Generally, if you're doing this for real, you would have to try different initial weights because the initial weight would affect the search, right? The way that numerical optimization work is that essentially, you can imagine you have a curve. Something like that, right? You imagine you have a curve like that. And it moves around based on the slope. Let's say you're here. Well, that would be unlikely since that would be a minimum. So let's say you are here, right? It's going to based on the slope and say, oh, this is going down, this is going up. Let's just go move up, and you reach a point which is higher than everything else, and that's a whoop maximum fun. But that is clearly not the global maximum, right? If you start from somewhere different, like here, then it would say, oh, go up, and it finds another different maximum, which in this case happens to be even higher. So the only way you can get around this problem is to try different initial values. Right. That's a limitation of numerical optimization. Right. So in any case, in our case, it looks like this is actually a pretty good combination because notice that the risk is even lower, right? 4.7%. So there is actually a substantial diversification benefit from buying free stocks. Right. Right. Okay. So, all right, so let's say we're happy with this, then this is okay. These are the weights we're going to use. In the next assignment, you actually need to do this portfolio optimization exercise for 2 time periods. As you see later on, what I want you to do is the first part, you'll be doing exactly the same with more stocks. But in the second part, I want you to check that these weights have actually check the Sharpe ratio and the return you get from the weights you derive in the first period. Essentially, I'm asking you to do an out of sample test. You derive the weights with the first half of the data and check whether the weights make sense in the second half of the data. Right. So this is something you have to do when you're actually doing this for real. Every portfolio formation strategy should go through this sort of testing. where you derive the rule, the parameter, you derive the parameters of your trading strategy with one set of data. And then you check those parameters with a separate set of data. This is very important in order to avoid overfitting particular time period, right? So it's rare because there are many things are happening in stock market at a time. What works in one period of time might very well not work in another period of time. And that's something you have to know as an investment manager. So you have to check. So in the assignment, you'll be asked to check. Form the portfolio with one particular period of time, and then check the weight, whether the weights work in the second period. So in the second period, you won't need to use the solver. You just construct the spreadsheet, replace these values with the new time period, and then check what Sharpe ratio you get at the end, right? Right. So you see that in the assignment. Okay. So that's for the Excel. Now it's time for saving. So